I want to sell a strangle, but why can't I just go 10% up or 10% down?
Right. We never move that far. You never talk about moving in percentages.
10% in 1 month is a pretty big move in most stocks.
Yes,
in the S&Ps, it's a huge move.
Yes.
But in most stocks, it's a pretty big move.
Barring earnings,
it's been
really
done.
isn't going to happen.
It's been done. But in the S&Ps, it's a pretty big move.
Yep.
So let's take a look.
In a month. Yep. Especially if you're rolling at 21
While
days.
occasionally a broker may raise the buying power requirement for a certain trade, typically they use the FINRA regulatory minimum. Tasty uses the FINRA regulatory minimum about, 85 to 90% of the time. As a quirk of the FINRA formula, for undefined risk trades, the lowest buying power requirement for a strangle tends to be with strikes about 10% out of the money. You can go back and look at the option jive from 5, 10, 22. For smaller accounts, they typically need to stay with defined risk trades in order to be buying power requirement efficient. But if you want to start branching out into undefined risk, what would be the outcome of using these minimum BPR strikes with the best, meaning this is kind of the area that has the lowest requirements? Okay, what's the downside of that? Let's take a look. Or is there a downside? We don't know.
Yep.
So we use 16 years of option data in the SPY. We examine the initial delta and the performance of strangles sold with 45 days to expiration, 10% out of the money strikes managed at 21 days. Okay, when 10% of the money, 10% of the money is pretty far.
Sure.
And the S&P's right in the SPY right now, it's a $400 stock, so get them with $40. It's a lot.
Yep.
For 1 month, or actually 24 days. We contrasted the values between high VR.
$400, right? You said $40?
It's a $400 stock, so 10%.
Oh, I'm looking at ES. I'm so sorry.
Yeah,
I'm so sorry.
10% would be $40. Yeah, ES would be, the SPX would be 400.
I apologize.
So we contrasted these values between high IVR and low IVR environments, because we like to sell premium and high IVR, and we considered high over 40. We compared the results to the outcomes of traders who stuck to the 45-day strangles with fixed initial deltas. I mean, Tony and I pretty much we're more along the lines of fixed, where we'll sell a 16 delta call, 16 delta put, that kind of thing. Where your put's probably more expensive than your call, but whatever. Let's take a look at the next slide. So it's going to be a little heavy here, research-wise, but it's going to get to our point relatively quickly. So we went to a 10% out of the money strangle here, and we took a look to see how does this play out. So the average call, unfortunately, only had 3 deltas. So you can't really go 10% out of the money on the call side. That's why the buying power requirement is so low, because the call, remember, and this is a little nuance of the requirements, but they basically they lock you in till you get to 5%. Anything under 5%, it drops off dramatically. So the reason that the overall is so low, the delta wise, is because, and the reason that the requirements work so have this little advantage is because, generally speaking, we're in low IVR most of the time, and in low IVR, the average call is 1.2. Okay, 1.2 deltas. That has basically no requirement. And so, but the problem with that is that in low IVR, you don't make any money. The average P&L is a negative number. So you have a 95% pop and a negative P&L over 16 years worth of data. The put has a 9 delta, the call is a 1.2. In high IVR, it's tradable because you have the call average at 8.4, the put average at 17.7. Those are deltas.
In high IVR, which we've talked about forever, a lot of things open up to you that aren't open up to you in the regular, or 85% of the time when markets are normalized or very low the way they are.
So does it work in all environments? And the answer is yes. Is it worth the risk? Ugh, I don't know. For $5.33, with a 92% pop, probably not a great return on capital. We didn't do return on capital. Probably not a great return on capital. Let's go to the next slide. So now we just take it a little bit further, and we look at the top line, which is what we took off the last slide, right? But we added C-bar to this. So what's your conditional value at risk? What's your back end, your worst 5% of the risk? So your pop was 92%, your average P&L was 533, and okay, your C-bar was 612. Got it.
That's your conditional value at risk, right?
We're going to compare this to 16 delta strangles and to 10 delta strangles, which is more. I mean, the 16 delta is kind of more along the lines of what we do, right? So the 16 delta put, the 16 delta call. So your pop drops down to 79%, to 80%, but your average P&L goes up by 5x.
Is that trade-off worth it to you? It is to me.
Of course. Well, look at the 10 delta, 82, and 21, you make 4 times as much or 5 times as much. And the answer here is that, you take basically the same amount of risk. Your pop drops down a little bit, but you make 5 times so much money. That's what we call pot odds.
Yep.
That's all that is.
Right.
Like if I'm going to drop my pop down by, let's call it 10% or 15%.
Pop is probability of profit.
Probability of profit. You got to give me some multiple of my P&L. And what we're showing here is that you get a multiple of 4x or a multiple of 5x if you go with the kind of the more normal standard strangles, and your C-bar basically stays the same. So the better play
seems like a no-brainer.
The better play is kind of the way we already do it. And it's essentially addressing, like, instead of saying, hey, we're going to go to 5%, we're going to go 5% of the money or 10% of the money or 20% of the money. The better way to do it is to stick with the deltas and assume that the pricing skew that's embedded is actually correct, because it is. Let's go to the last slide. So due to the regulatory formula, the lowest buying power requirement for a strangle is usually strikes about 10% away from the spot price, regardless of expiration and volatility. But for a given strike, the delta increases as we look further out, as we look at further out expirations or volatility increases. So these 10% strikes forced us into long delta because remember, the put's bigger than the call if you go 10% of the money. So due to the volatility skew, and at the 45 DTE, we're likely too little credit per trade to be worthwhile, especially on the call side, except during extremely high volatility. So a small account, or a retail account, we should say, looking for its first taste of undefined risk, can wait for high volatility or consider a long-dated, low BPR strangle. But active traders should look to trade with a more reasonable days to expiration and delta, more reasonable delta, in order to get in order to get P&L without increasing your conditional value at risk, even if it means putting up more buying power. So the trade-off here is there's a better risk reward and it's better pot odds for playing the game with a little bit more buying power, but going for a more balanced strangle. And that's the way we've always traded it.
Very good, sir.
It's just validating what we already do.
Good job out of you. Better job out of the research team. We'll take a quick 90-second break. We'll come back. We got more Tasty Live with, oh joy, Mr. Scott Sheridan coming in. Tasty Trade World Headquarters. Best platform in the universe. Next.